Good morning, ladies and gentlemen. Fiscal 2016 was marked by strong financial performance for Laurentian Bank. Adjusted net income reached $187 million, or $5.70 per diluted share. Adjusted net income increased by 9% from a year earlier, and adjusted diluted EPS increased by 1%. EPS was impacted by 5% more shares outstanding, as well as higher preferred share dividends compared to a year ago. Adjusted ROE was maintained at 12% and was achieved as the bank strengthened its capital position. Reported results for 2016 took into account impairment and restructuring charges of $28.1 million after taxes, which related to the bank's decision to optimize its retail activities. This resulted in net income of $151.9 million, or $4.55 per share. Core earnings were positively impacted by the strong momentum that we have and the good progress that we're making in key elements of our transformation plan. Specifically, in 2016, we achieved growth in loans to business customers of 25%. Excluding CIT Canada's portfolio, organic growth was 13%. As well, growth in residential mortgage loans through independent brokers and advisors reached 23%. Overall, our revenues in 2016 grew by 2%, while adjusted non-interest expenses remained relatively unchanged compared to 2015. Our adjusted efficiency ratio of 69.6% improved by 170 basis points compared to a year earlier. We remained very satisfied with the credit quality of our loan portfolios. In 2016, the provision for credit losses stood at $33.4 million, or $1.6 million lower than in 2015. This represents a ratio of provisions for credit losses as a percentage of average loans and acceptances of only 11 basis points. Contributing to this low loss ratio are disciplined underwriting standards. Over the medium term, we expect the loss ratio to gradually move higher as our business mix evolves, but it should be more than offset by higher net interest income. In 2016, we completed 3 share offerings: a $67.5 million common share issuance, as well as a $125 million preferred share issuance in the first half of the year. And to support the CIT Canada transaction, a $155.4 million common share issuance in the fourth quarter. Having a strong capital base allows the bank to transform and continue to take advantage of opportunities as they arise. Furthermore, the Board of Directors increased the dividend on common share twice in the year, the first time in June 2016 and again in December 2016. Yesterday, the bank reported strong financial performance for the first quarter ended January 31st, 2017. Adjusted net income totaled $52.7 million, an increase of 21% compared to a year earlier. Adjusted diluted EPS were $1.43, an increase of 3%, reflecting 14% more common shares outstanding, as well as higher dividends on preferred shares compared to the first quarter of 2016. On a reported basis, net income and diluted EPS were $48.5 million and $1.30, respectively. Adjusted ROE at 11.8% was relatively flat compared to 11.9% in the first quarter of 2016. It is noteworthy that the bank's capital position has strengthened. The CET1 ratio, calculated according to the standardized approach, stood at 8.2% at the end of the first quarter of 2017, up 50 basis points from a year earlier. Earnings were positively impacted by the strong momentum that we have in generating growth in targeted segments across Canada. Loans to business customers and residential mortgage loans through independent brokers and advisors increased 23% and 16%, respectively, compared to a year earlier. As well, higher revenue and expense control contributed to an improved adjusted efficiency ratio and positive adjusted operating leverage. Good credit quality continued to be reflected in relatively low credit losses. With this solid performance, 2017 is off to a good start. With the transformation plan aimed at improving performance, we're making progress towards achieving our medium-term financial objectives. First, in terms of narrowing the ROE gap to 300 basis points compared to the major Canadian banks by 2019, in the first quarter of 2017, the gap was 360 basis points relative to 2016. We will be able to update this metric once all banks have reported their first quarter results. Second, with respect to moving the efficiency ratio below 68% by 2019, at the end of the first quarter to 2017, the adjusted efficiency ratio stood at 67.4%. Third, in terms of growing diluted earnings per share by 5 to 10% annually, in the first quarter of 2017, EPS growth was 3%. And finally, the bank generated positive adjusted operating leverage of 4.5% in the first quarter of 2017. Furthermore, we're continuing to harness the bank's strengths to achieve the 2019 growth targets. Let me remind you that since the inception of the transformation plan at the end of 2015, loans to business customers have increased by $2.1 billion and now stand at $10.1 billion. We are well on our way to attaining the $13 billion target by 2019. Similarly, residential mortgage loans through independent brokers and advisors have grown by $1.6 billion from the end of 2015 and currently total $7.3 billion, on track to meet the $9 billion target. Mutual funds to retail assets, to retail customers and assets under management at Laurentian Bank Securities have grown by $200 million and $600 million, respectively, over the last 15 months, on the path towards reaching the respective $6 billion and $4 billion 2019 objectives. In conclusion, we're very pleased with our result and our progress, both in 2016 and for the first quarter of 2017. At the same time, we're confident that our transformation plan positions us very well for future sustainable growth.